So there are two different types of portfolios you can build in analytics, a static and a dynamic one. We've got a couple loaded up here. This is my example of a static portfolio, and this one is our own FE Investments model portfolio, and that's dynamically updating historically. Now, the easiest way to explain the differences between them visually is to open up each one. So we'll start with Keith Baker, my static portfolio. And when the screen loads up, you can see over on the right-hand side, the portfolio has 11 funds in it. All those different percentage weightings applied as well. And that's an example of a static portfolio, because whatever you do with this portfolio, a chart, a report, or a table, the system will only ever assume that you've had those 11 funds since the birth of this portfolio from day one till today. Now, if we take a look inside the other portfolio, you can see the right-hand side of the screen changes a bit. Every single time I've made a historic change to this portfolio, it could just be a simple rebalance, it could be a fund swap, it could be a complete overhaul. Every single change that has occurred historically from today right the way back to the launch date of the portfolio has been recorded. So I'll always have a current tab that's automatically updating each day, and I can go back in time, so I can see back in April 2021 changes were made to that portfolio. In October 2020 further changes are made, etc. And I can go right the way back to the launch date of 2012, and I can see what that portfolio invested in all the way back in 2012. So what does that look like when we come to chart the solutions? Well, on the right hand side, if I throw that data into a 5-year performance graph and click on generate, you can see a subtle difference between the two lines. The red line is just a very straight linear line that goes from today all the way back to September 2016. Now the blue line you can see is lumpy. It's got little dots in there. Every 6 months when we made a change to the portfolio, it indicates a change has taken place. And that's a core difference between the two portfolios. Again, the system assumes that you've always had those funds in Keith Baker's portfolio, and it's just simply backtesting the performance of those. Whereas the blue line, you would argue, is far more accurate because it's able to take into account the performance of your portfolio net of all those historical transactions. Now, if we move on to looking at how to create a dynamic portfolio, it's probably worth pointing out quickly that if you're using a model portfolio solution via a platform, there's a very good chance we already have that model portfolio solution plumbed into analytics already, so you don't need to dynamically build them yourself. If you go to this tab on the left, Portfolio Tools, click on the MPS directory, that will load up all of the providers, scroll down to the one you want to have a look at, click on it, it showcases who they are and what they do. If you scroll down and hit Activate Me, you'll be activated for their model portfolio proposition. Now, what does that mean? Back in analytics, if you click on the portfolio tab, all of their model portfolios will be plugged in, and they're examples of dynamic portfolios because all of the history has been added to the portfolio, and they'll be dynamically updating daily. So if that DFM provider makes a change to the portfolio, that will automatically filter across into your account. So those are already kind of baked into the system already. But admittedly, if you're not using an MPS solution and you do want to build your own dynamic portfolio, then the first thing you've got to do is start a brand new portfolio, which is that one there. And when the screen opens, you really need to start from day one of your portfolio. If you cast your mind back, what did your portfolio start as? So on the left-hand side, if you find the funds you started investing into, and I'm just going to make this really simple, I'm going to just simply use one provider. So we're going to use Allianz, and underneath that there's all of their funds. So I'm going to say that 4 or 5 years ago, I started investing in the Continental European Fund, started investing in the emerging markets equity, also the strategic bond, and maybe the US equity, and add that across. Percentage-wise, again, you can do value, units, or percentages. It's up to you, but I'll do 25% in each. Now, the one way in which this differs from a standard portfolio is at this stage you generally tend to save the portfolio and then start analysing it. With this, you click on this little tab here and actually start applying dates. So for me, when did I start this portfolio? This started, I'm just going to make this really simple, started on 1st of January, but again, it can be any date you like. I'm going to start this portfolio on 1st of January, let's say 2017, right, and click on OK, and it creates a new tab for me. And now I've got to save this portfolio. So I'll click on Save, and I'll call this my historic portfolio demo, and click on Save. And that will save the first part of the portfolio. And now every single time a change has occurred in this portfolio, there's really just 3 things you've got to do. You've got to create a new date, make a change, click on Save. So in this case, perhaps a year later, in 2018, we made a slight adjustment to the portfolio. Then first of all, I've got to tell it what date that was. So click on the tab, create a new date. Let's just mix it up a bit. Let's just say the 3rd of the, let's say May 2018. That's the next time I made a change. Second thing I've got to do, make the change, what actually took place on that date. Maybe we decided to reduce the holding in US equities, bring that down to 10%. Maybe we decided to bring in UK opportunities and add 15% into that. So now I have 5 funds in my portfolio rather than 4. Now, invariably, if you've had to sell out of a fund, you obviously just delete it, get rid of it. And in this case, once I'm happy, the third thing I've got to do is simply hit that little save icon and it will save that next change. Now, a rebalance is even easier because there aren't really any changes you're making. You're just reapplying the old percentage weightings. So if you think of the same 3-step process, create a date. So maybe I just made a very simple rebalance in 2019, just back to the same percentage weightings. So click on the tab, create a date. Again, I'll just do the same kind of date, 3rd of the 5th, 2019. Click on OK. What took place? Well, nothing. We just reapplied the same percentages, so I don't need to touch that. And I can skip to the 3rd step, which is to save. And there again, I've created a new tab. You can create as many tabs as you like, and ultimately they'll just be daisy chained together when you go and create the final chart. But once you're done, close the screen, come back to your main analytics screen, and over on the left-hand side, the portfolio will be ready and waiting for you. Now, lastly, when you actually go and create some charts again on these dynamic portfolios, and they show the little dots indicating when a change took place, the secondary benefit to this is you can show what would have happened had those changes not taken place. So run your own due diligence. So under the options tab at the top, whatever chart you're creating here, click on chart options. Every single time you've made a change will be simply listed. So I'm going to select the very first change we made at the very bottom, click on OK. You can even change the colours of this as well. It will now grow a little yellow line away from it, and it will show us that, well, look, had we just left our portfolio drift on day 1 and not made any changes, it would have continued on that yellow path, and right now it would be at 34.9%, whereas actually, because we have been making changes along the way, we've obviously stuck to the correct risk profile, but also it would have increased the performance by about 9% on top of where it would have been had we just left it. A query we get coming through our help desk quite a lot is, how do I get around the issue of having a young fund in my portfolio? If you cast your mind back to that static portfolio we were looking at earlier, the one problem with a static portfolio is if there's a fund within my portfolio that's quite young, so it was born in 2017, I won't be able to take the history back too far. It's going to stop at the youngest fund, which in that case is going to be 2017. One of the benefits of a dynamic portfolio tool, though, is it doesn't matter anymore about the age of the fund. It's about the solution itself. So as you can see in my solution here, if I were to create a performance graph of this portfolio, I'd be able to go back to 2012. In fact, to the 1st of June 2012, because that's when my portfolio was born. It just so happens that there is actually a fund in my portfolio that was born in August 2017, but it doesn't matter. It won't restrict the length of history I'll be able to go back, because pre-August 2017, I invariably didn't invest in that fund because it wasn't around to invest in. I would have invested in other things. So if you think of these tabs at the top as almost mini portfolios that you're then just gluing together when you go and create a line chart. So I hope you found that tutorial useful. There's lots of different ways in which you can use that dynamic portfolio tool, so play around with it. You don't just have to use it on funds either. You're more than welcome to mess around with indices and sectors and mix that with some funds as well. Our clients can create really interesting proxies for performance of a portfolio. So if I've got a portfolio that itself is quite young, maybe it's only been running for a few years, I can build a dynamic portfolio that starts investing in a mix of indices that mimic the asset allocation of that portfolio, and perhaps start my portfolio back in the 60s, the 70s, the 80s, and draw long performance history up until the most recent time period where my portfolio was actually born, and essentially allow myself to stitch all that history together so I can create long-term analysis for my clients to show them over different market conditions, different decades, how my model would have reacted during those market conditions. Even though it wasn't born, I can still mimic asset allocations by blending indices together and then swapping them with the funds as and when my model was born. As ever, if you've got any further questions on this, feel free to chat with an expert in the bottom right. There's a help desk, contact us on the left-hand side as well, their contact details. And if you need to book yourself in for some training, scheduled training there, and further guides, quite useful to read.